Hi everyone, welcome to today's webinar. My name is Fawad Razaqzada, market analyst with Think Markets. I'm based in London. So if you guys are watching this on YouTube, please make sure to join us live next time because this webinar is meant to be quite interactive, allowing the participants to ask me any questions about the markets. So you won't be able to do that on YouTube, but if you could make it live next time, please do so. Please do join me. And for those of you who are here, welcome on board. And please don't hesitate to ask me questions anytime about any market, okay? Before we proceed, please read through the risk warning. I'm going to read the first paragraph with you guys, and then we will proceed. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. All right, let's crack on. So just a quick reminder of the agenda. This webinar happens every Tuesday at 11:30 London time. Mainly, it's technical analysis on major currencies, gold, and indices. We do touch on fundamentals as well. So stock markets have come down a little bit, but overall, they remain supported because of ongoing reflation trade. Actually, technology companies have underperformed quite sharply in the last few days. And US index futures were lower at the time of this webinar. This is because, companies that had benefited from the pandemic-induced lockdowns, they are among the biggest fallers. A few countries have already outlined their reopening plans, like the UK, for example, did. So it's the technology companies that are now going the opposite after outperforming the markets during the pandemic. So investors are betting that inflation is going to be the result of a sharp economic recovery because of the ongoing government and central bank stimulus, as well as expected growth to return once lockdowns end. So all of that have helped to push bond yields to levels not seen before the pandemic. If I can show you the 10-year yields here. This is the 10-year US government bond yields. As you can see, it's been rising rapidly in the last several weeks, making higher highs and higher lows. And we hit 1.375 yesterday, and we are trading at around that level at the start of today's session. It's not just the US. If you look at yields across the board, here, the German 10-year bonds, likewise climbing, albeit slowly compared to the US, but climbing nonetheless. And similarly, the UK 10-year yields are pushing higher. So the UK is miles ahead of everyone else in Europe in terms of vaccinating its population. And the government has outlined plans to slowly open up the economy, starting from 8th of March, with the schools returning. And this, as well as the fact that the UK government had avoided, the UK as a country avoided a no-deal Brexit, are reasons why the pound has been going up really sharply over the last several weeks. And you can see that the daily chart showing prices have broken above 140 handle, where I expected, and from the previous webinars, if you remember, that we will get there, and we have got there. So the key question is where to next from here? Well, fundamentally, there's nothing to there are not a lot of bearish factors right now to hold back the pound, if you think about it. Yes, the economy is quite weak at the moment, but that's the case with the world economy hit by the pandemic. The markets are forward-looking; they're looking ahead, 2 to 3, 4 months time, and in the UK, people are expecting the economy to reopen and pent-up demand to drive growth, and that's why the pound has been climbing sharply higher across the board, not just against the dollar. The euro pound, for example, has been falling really rapidly ever since it broke out from that head and shoulders pattern that we highlighted a few weeks ago, or a month or so ago. And it continues to go down, breaking below key supports such as 87. The next downside target is 85. Should we get there? Because that level is, or was, a prior resistance zone before that big breakout. I think over time it will get there and possibly head further lower, reaching 83, where previously the euro pound had found double bottom from. So the pound remains on the back on the front foot, and pound crosses look quite strong. Look at the pound yen. It's continuing to follow the path from the previous update, as you can see by the note here. It's broken out from this long-term triangle that was in place with the bearish trend of the or the bearish long-term trend line, which was in place since 2018. That gave way a few weeks ago, and since then prices really taken off, breaking further resistances such as 145, and now it's trying to break 147.96. Call that 148, okay? Because that was the previous high hit in 2019. That level is now going to be our first key support on rounded retest if we start to move away from it more decisively. So say it goes to 149ish or something, and then it goes back down. When it tests this level, you should be expecting a bounce from that level. If it goes below that and hold below it on a daily closing basis, then that could pave the way for a deeper retracement. But ultimately, the trend is bullish. Okay, the 200 days is rising, the 21-day exponential is rising. You have these bullish trend lines, price making higher highs and higher lows. So there's nothing bearish about this. Try not to short this unless the charts tell you it's time to do so. So just taking out, bearish trades from the pound could be a massive advantage, if you trade both directions, because you want to be going with the trend, right? Because if you're going with the trend, and even if you don't time the entry well, the market in a strong rising strong rising markets, they gave you lots of opportunities to make mistakes and come out of it without too much harm. I'm not saying that you should be chasing the market like as it makes new highs, but trading in the direction of the trend has lots of advantages. Okay, so that's the pound. There's another one, pound yen. No, pound Swiss that we've previously touched on. And pound Swiss is looking amazing. It's ever since it broke out from this consolidation zone, it's just been a one-way trade. Look at that. It's coming up to 128, 127, 128 region, which had previously offered some resistance, leading to that big drop in 2020. But like all the other pound crosses, the pace of the rally, the way it's looking really strong. So I wouldn't fight this, even if it forms like a toppy candle, like a hammer or something, inverted hammer. I would actually wait for that to happen, wait for price to go down, and then try to look to buy the dip. So talking about the franc, the franc is it's considered a haven currency. So at times like now, when the world economy is expected to rebound, then you want to look for shorting haven currencies like the Japanese yen, the Swiss franc, and to some degree the dollar, the US dollar as well. But the Swiss franc is looking quite weak against the pound. But look at it also against the euro. Okay, the euro is obviously not the strongest currency at the moment, but it could do what the pound is doing because the pound and the euro have got a very strong correlation. The pound dollar against the US dollar have got very strong correlation, historically speaking. So I'm expecting the euro dollar to rise like the pound has done in the coming weeks. But this could, the euro's strength could be more apparent against the likes of the franc. Sorry, guys, just give me 1 second. I was going to say the euro's strength can become more apparent against the likes of the Swiss franc. This chart shows, I was previously expecting a big breakout. It didn't happen the way I had expected it. Nonetheless, it has broken out now. It came back down deeper than I had expected, testing the 200-day for a couple of times, on a few separate occasions before breaking out. Now that we have broken out, these are the kind of levels you want to see hold. So on the upside, this area right here is really important to hold as support on potential retests. And I reckon we could see something like this. So price has broken out, to come back down, retest this area, and then take off. So showing you a historical chart of the Euro Swiss. It's a forgotten currency pair. If you're new to the market, you may not have heard many people talk about the Euro Swiss, but the Euro Swiss was historically a heavily traded market, and it caused a lot of problems for people back in 2015. I remember I was holding a long Euro Swiss position at that time. The market tanked. Luckily, I had a stop loss, which got triggered just below the 120 handle. For some people, their stops, there were big gaps, and they lost a ton of money when the Swiss National Bank removed that floor, that 124 from its currency cross. Anyway, it was a very popular market back in the days, but since the ECB's, SNB's intervention, it's kind of lost its shine, and people have been focusing elsewhere. But I think it's one market to watch out for because of the recent developments. We've broken out of this consolidation zone to the upside. We've taken out these bearish lines. So I think the Euro Swiss is going to start rising back to much higher levels from here. So yeah, keep a close eye on that. Let's now move on to the more traditional markets, the euro dollar maybe. This is the daily chart of the euro dollar, and with the dollar kind of weakening, the euro has managed to hold its own relatively well, and is so far following the path from the previous update, as you can see. I reckon it's going to climb to 125 and possibly higher over time. The reason for that is if you go to the longer term time frames, like the weekly chart, you can see that price is following a similar path to what happened at the back end of 2016 early 2017 all the way to the early parts of 2018, when price rallied sharply, consolidated for a while, and then it took off again. Here you can see a similar pattern. It's kind of rallied really strongly since bottoming out in March 2020. It then went into a period of consolidation, and now it's taking off again, albeit slow at a slower pace than it did over here. But if history is to repeat itself, then we can see it move above 125 and above the 2018 high in the coming weeks. Notice that the longer term chart is also showing a few bullish signs. For example, when price formed this false break reversal here, that's a major reversal, right? But here, when it in 2020, March 2020, when it looked really bleak at one point, it looked like it was going to take out the previous low. It didn't. It started to push higher. As a result of that, it formed a higher low relative to this low. So that in itself is a massive bullish signal. And the fact it's since moved on to take out the long-term bearish trend, which you can see quite clearly on a monthly chart. So this is the monthly. You can see that the long-term bearish trend line has been taken out. So from here, it looks like price could easily climb to 125 and possibly hit all the way to the 130 handle in the coming months. So in other words, the path of least resistance is to the upside for the euro dollar, and that's the way I want to play it. So when looking at the chart, we had a couple of false break of the trend lines. For example, if you look at that black trend line here, we broke below it, and price looked at one stage it was going to go down, but before breaking higher again. Similarly, if you look at the blue trend line, there was a brief break below it, and a lot of people were quite bearish on the euro at that point. I said, I'm not quite sure, because of the historical charts being bullish. I said if it goes back above the broken trend line, then I would reinstate my bullish bias on this share. And that's what happened. It went back above, and although it came back one more time to retest the trend, it didn't really take out the prior low of medium bearish or the key support at 120. So that level 120 is the line in the sand for me. If we go below that level again, 120, then I think I might drop my bullish view on the euro dollar. But for as long as that 120 holds, I think resistance will be the upside. Indeed, I reckon it's going to break this shaded resistance area soon, between 121.50 to 121.80, this shaded region. If it breaks to that, then a rounded retest of that zone could provide a nice tradable bounce to take us to new highs for the year, possibly towards that 2018 high of 125.55 next. So that's the bullish scenario I'm looking at for now. Region and then a rounded retest is what I'm looking for. Make sense? So yeah, that's the euro dollar. Similarly, if you look at the Aussie, there's a bullish trend line, price making higher highs and higher lows. Here, the Aussie dollar is coming a little bit lower amid profit taking, but the chart is pointing higher, and some of the levels to look for potential. Obviously, I'm not providing any trading advice here, but levels to look for possible long entries around old resistance levels such as 78.15 or 77.90-ish, this area here, where we also have that long-term bullish trend line coming into play. The New Zealand dollar has spoken about this pennant formation consolidation, similar to what it did here. So if you want to look for some specific levels, then just clone this. This level right here, the base of the breakout at 65-ish, is a key level, maybe slightly below that right here, because that level touches more highs of these candles around 72.50. So 50 is a key support to watch. Dollar CAD is looking quite bleak. Every time it looks like it wants to push higher, it gets slammed back down because of the ongoing reflationary trade and also because of rallying crude oil prices. It is right now testing the prior 2020 low at 125.89, call it 125.90. We need to see price break through that on a daily closing basis next for the trend to continue heading lower. However, if it breaks above the shaded region, then at that point you'd have to drop your bearish price on this particular market. So far, it's looking quite bearish. Let's have a look at a couple of commodities, starting with gold, maybe. So this is the weekly chart of gold. And first of all, I want to highlight this shaded region. Why I have that marked up. Well, if you look at your historical charts in 2011, 2012, and 2000, twice in 2012, once in 2011, this area had been strong resistance leading to a big breakdown, right? So that's why I have highlighted this area as being potential support. And as you can see, this level or area had provided resistance here in May 2020. After that point in June, price broke above it. It then came back down, retested it once, retested it twice, 4 times here. So far, it's holding above, but because of the ongoing risk-on trade with value stocks outperforming and so on, people are not really keen to buy haven assets like gold and silver, especially gold, because silver is a different case. It's more of a commodity metal. It's got lots of industrial uses, whereas gold is deemed more to be a haven asset than silver. So that's why we are not seeing much demand for gold at the moment. However, it's still clinging on to this long-term support area. So if you're turning bearish on gold, I think it's best to wait for a price to make a clean break below this key support, 1765 to 1800, before looking for bearish trades. If you are still bullish on gold, perhaps waiting for price to break out of this falling pattern would be an ideal scenario, because otherwise it's still inside consolidation and in kind of no man's land, at least on a weekly pattern. So now if you go to the daily, you will see price action in more detail. On the daily, it's testing that potential resistance zone here between 1810 to 1816. This level, or area I should say, was previously support, leading to that breakdown of last week. Prices now returned to this area, it's testing it, and so far this area is turning into resistance. So as a very minimum, if you're bullish on gold, it needs to break through this area first. More to the point, I want to see gold break above the most recent high that led to the recent breakdown. Okay, so I want gold to move above 1855 for me to turn bullish on gold once again. At the moment, I don't have a strong view on gold. I used to be very bullish on gold, and I think gold could hit a lot higher in the long term, but in the short to medium terms, I'm not so sure anymore. I don't know whether there's too much desire for people to be holding gold at times like now, when things are expected to open up. But with the dollar, weakening across the board, that should, in theory, support gold prices. Also, It's a question of jewelry demand as the world economy recovers. That's going to rise as well. So there are reasons for and against gold in both, from both a bullish and bearish point of view. So for that reason, I'm not too sure where gold is going to head to next. So that's why I have laid out scenarios from a technical point of view to, if a certain condition is met, then I would trade it this way or that way. So for example, in this case, if it breaks that 1855 level, the previous high, then at that point I would start looking for bullish trades. Yes, I will have missed all this move to get to that level, but at least I would have some confirmation to go up. In terms of bearish scenario, I would wait for price to break that long-term support zone I showed you on the weekly chart. Let's move on to silver. Silver is looking more. It's looking more constructive from a technical point of view because it's holding above the long-term bullish trend line. It's taken out the short-term bearish trend. Yes, they made a double top at 130 at 30 level here, but there hasn't been significant downside follow through yet. Indeed, it's holding the key support area I've highlighted on the chart, and in the last couple of days, it's kind of tried to break above that zone. So, out of the two metals, I think silver has a better chance of making a more decisive breakout attempt than gold. Indeed, silver has a strong positive correlation with copper prices. So if you look at copper, this is what copper has done, and it's been like most other markets, it's been a one-way trade since March 2020 when everything bottomed out. So in recent days, copper accelerated this rally because of expectations or a speculation that the world economy is going to recover. So if you plot a chart of silver onto the chart of copper, let me do that for you right now. Let's ignore the moving averages because there's one more. Yeah, there you go. Okay, so this is the orange line is silver. The candles are copper prices. If you zoom out, you can see that the two markets they've diverged from around July of 2020 with then it was silver that made its big move, and then copper eventually caught up. But since November 2020, it's been, or maybe a little bit later, it's been since the start of this year, it's been copper that has led the rally, and silver is slowly catching up. So if silver is to continue following copper prices, then expect something like this to potentially take place in silver in the coming weeks. So there you have it. I think if it does break out, 30 is obviously a massive level. Above that, you have these Fibonacci extension levels drawn from the most recent. But potentially, silver could go a lot higher, because if you look at the historical charts, this is the weekly chart of silver. Unlike gold, it's still miles away from its 2011 high. Gold has already reached and surpassed this level before coming back below it, right? Silver has not retested its own corresponding level of just under $50 yet, but it has the potential to rise towards that level in the coming weeks and months. So silver is looking, has got more potential upside than gold, in my view. And I think if you're looking for a bullish trade, I would certainly look at silver more than I would gold. Let's talk about a couple of indices and then we'll wrap it up there. Now, so as I mentioned at the start of the webinar, technology companies are looking quite weak at the moment because of the ongoing reflation trade. Remember, technology companies had led the rally during lockdown, but now that lockdowns are hopefully going to end soon, people are kind of rotating into value stocks that tend to go up with the economy. That being said, it's not the end of NASDAQ by any means, or technology companies, but where we are at the moment, there's a possibility that we could see a bounce because it's testing this bullish trend line that has been in place since March 2020. The next logical level is this high here at 12,466-ish. A correction of some sort should have been expected anyway, because the index was looking severely overbought. In contrast, if you look at the Russell 2000 futures, or CFDs in this case, very small pullback from the all-time highs. So that clearly shows that people are moving into the stocks that are sensitive to economic growth rather than growth stocks with technology companies growing rapidly in value in the last several years. So the S&P is a mix of the two, really. If I go to the S&P chart, you can see that it's pulled back a little bit deeper than the Russell. And it's testing the potential support area shown on the chart, which was previously resistance. So it could bounce from here, the S&P 500. Again, the underlying trend is bullish, and it will remain that way for as long as this bullish trend holds, or until we break below the most recent low, which in this case was at 3,664 was the last swing low. So for as long as that level remains intact, the path of least resistance, despite the recent weakness, is still to the upside. In Europe, the FTSE is looking quite interesting. There are lots of value stocks in the FTSE. The FTSE hasn't done what the US markets have done. It's barely moved higher since the pandemic. With no deal Brexit being avoided at the back end of last year, and with the UK economy expected to return, to open up, things should look positive for UK listed stocks. Now, the problem for the UK, for the FTSE 100 is this. Firstly, the 100 stocks listed in the FTSE are multinational corporations, so their performance is dependent on the global rather than local economy. And most of their earnings are made in euros and in dollars rather than in pounds. So with the pound rallying right now, when these companies convert those earnings made abroad back into pounds, their earnings wouldn't look as good in pound terms as they would in dollars or euros terms. So the exchange rate is having a negative impact on the FTSE. But I think this is going to be a temporary impact. I don't think it's going to be a long-term factor. You know, talking about the technical side of things on the FTSE, recently it broke out of this bull flag pattern. Nice breakout. It then stalled, and the index has now come back down to retest this broken resistance area, which is now our key support area to look at for. And so far, it's kind of holding above that zone, well, within that zone. I reckon it's going to stop moving higher, initially finding some resistance at 6,700, ahead of more gains thereafter. But yeah, the markets do look a little bit heavy on the top side in the US, which is something to keep an eye on. But in Europe, the for as long as the FTSE holds above this trend line, I think it's still bullish. But yeah, keep an eye on the US markets, as I said, because they have come down a little bit, and the FTSE and all the other indices, they tend to go in the same general direction. So if the US markets were to correct themselves sharply, then the FTSE is likely to follow suit, albeit it's unlikely to fall by the same amount or extent as the US markets, but it could fall nonetheless. Still though, I think from a bullish point of view, the FTSE has a lot of catching up to do with global indices. So pay attention to it if you're bullish on the stock markets. Guys, if you have any questions, please ask me now, because we have run out of time. This webinar is meant to be half an hour. It's coming up to 35 minutes or so now since we started. So I don't want to bore you guys. Unless you have any questions, I'm going to end the webinar. So I'm just going to wait a couple of more minutes to see if there are any questions. You can ask me in the questions box or in the chat box. Okay, it seems like there are no questions, so I'm gonna end the webinar here. Thank you so much for listening. If you're watching this on YouTube, please make sure to join us live next time. You can join us very easily by going to our website at Think Markets, and on the Market Analysis tab, you have the live webinars. Click on that, and all the live upcoming webinars are listed here. You can register, and then you'll be able to join us live next time. The advantage of joining us live is obvious. You can ask us lots of questions about any market that you are interested in, rather than anything that I want to talk about. We'll be more than happy to provide live analysis, live technical analysis on any market that you want us to cover. So please bear that in mind for next time. And thank you once again for joining me. I wish you have a wonderful week ahead. Take care and speak to you next time. Bye.